Good afternoon. I hope everyone is doing well. Welcome to the ESCP Business School Bachelor in Management Masterclass, Understanding Currency Exchange Rates. My name is Tania Fernandez, and I'm in charge of Marketing and Communication at the Madrid campus. I would like to present our speaker for today, Professor Jaime Peluque. Jaime is an associate professor of economics at ESCP Business School Madrid campus, where he holds the BNP Paribas professorship in real estate and serves as director of the Monaco Real Estate Tech Innovation Program. He is also the academic director of the MSc in Real Estate, the MSc in Hospitality and Tourism Management, and the Institute of Real Estate Finance and Management. Prior to joining ESCP in July 2018, he was an associate professor of real estate at the University of Wisconsin-Madison School of Business. Jaime's main academic research applies generally equilibrium theory to financial and real estate markets. He has conducted research on the consequence of repo and rehypothecation on security pricing and market pressures. This line of research evolved toward the understanding of leverage dynamics, security bubbles, anomalies in currency markets, and banks' portfolio rebalancing in sovereign debt crisis. Jaime's teaching specialization include real estate finance, real estate economics, urban economics, and macroeconomics. He has taught in the MBA, MSc, and BBA program. Jaime is the recipient of the 2017 Ideas Worth Teaching Award by the Aspen Institute Business and Society Program for his educational innovations. Well, thank you, Jaime, for being here with us. This masterclass is sought to be very interactive, and to do so, you will be participating through the Mentimeter tool. So we have some tips for you. If you're watching this from your desktop or PC, open a separate window in your browser, or if you prefer, use a separate device such as a mobile phone or a tablet and open up a browser there. Then there you will enter the www.menti.com. Don't worry, you're going to have it on the presentation in a moment. When Professor Luque asks you a question, you will see the code on the slide. You just will have to enter that code on the menti.com window, and then you will see a slide with all the questions we're presenting. Answer them as indicated, and you will see the results. So also regarding the masterclass, if you have any questions along the way, please put your questions on the question window, and Professor Luque will be happy to answer them at the end of the masterclass. We encourage you to participate so that you get the most out of this experience. Thank you and enjoy the webinar. Gracias, Professor.
Thank you very much, Tania, for this great introduction. Well, hello, everybody. I'm happy to give this guest lecture for those of you that are considering joining us in the bachelor program. The topic I chose for today, it's a very important topic because it captures the part of the skills that you need to know after you graduate in this school. If you are an ESCP student, you will have a very international profile. You will be very attractive to international companies. So it's very likely that you end up working for an international company. Working for an international company means that you need to make business at the international level. That means different countries. And a very key point once you do international business is that you are exposed to different currencies. So the same as when you go, say, from say Spain to United Kingdom, you have to sell your euros and buy sterling pounds. Once you go and do business, you have to do the same kind of thing because you buy at the local currency, and that may have an impact on your balance sheet of your company once you translate that revenue in a different currency into your own currency. So what I'm going to teach you today is how to understand the exchange rate from a market level perspective, and also how you understand like different shocks that affect economies and how this translates into different movements in the exchange rate. Understanding exchange rates is crucial for you to basically diminish the risk, the currency risk that you might face when you do international business. So I hope you enjoy the topic. I'm going to start sharing some slides with you. And then, so the lecture is going to be basically giving you some brief intuition on how the market for currencies work. Then I'm going to ask you some questions, so that basically I'm going to try to see if you understand things. I'm going to explain things along those questions. And then we are going to see a video of an interview very briefly, and we're going to discuss things, and that's going to be the lecture. And once the lecture is over, we're going to have some time for Q&A. Okay, so I'm going to share my slides. So give me 1 second, please. I'm going to share first the slides. Second thing I'm going to do is opening my screen. So I hope now all of you are seeing my slides. If not, Tanya, please stop me. Otherwise, I will assume that you're able to see the slides today. So yes. Okay, thank you, Tanya. So the title you see here is Understanding Currency Exchange Rates. I'm going to start with a very simple question. So how exchange rates are determined? And the key here, if you only have to, the takeaway from this lecture is probably what I'm going to say now. You're gonna price a currency in terms of another currency. For instance, if you want to buy sterling pounds, you have to price 1 pound in terms of euros, for instance. So if you say, well, now instead of buying, initially might be a 1-to-1. So with €1, you can buy 1 pound. Then there's a shock in the economy, and then you can buy with €1, you can only buy 0.9 pounds. That's a movement in the exchange rate. The question is how this exchange rate is determined. What are the market forces that are behind this price movement? So here we are going to look at demand and supply, as economists do. And the notion is scarcity. For instance, if we have one of the currencies, say pounds, very scarce, it's going to appreciate with respect to the other currency. So the scarcity implies that the currency appreciates with respect to the other one. That's the key notion to understand exchange rates in currency markets. If I talk about a free floating exchange rate, then I mean that there is no governmental interventions. It's just the market, demand and supply for currencies across the different stakeholders in the economy. Having defined what exchange rate is, wait a second. Okay, there we go. I'm going to start with I'm going to ask you questions. So let's start with a very simple one. So the question is, which country are you from? So I'm asking you to go to, please read at the top, is you go to menti.com and you're going to enter this number, the code I'm giving you, and then you enter your country. And as you enter your country, we're going to see other countries as well. Okay, we are now seeing Italy, Germany, Brazil, Mexico, Spain. Okay, other countries. You have to go to menti.com and then you have to use this code. So in any case, I had this question just to get you familiar with Mentimeter. This is the software we are going to use today to ask you questions and interact with the audience. So as you can see here, yes, it's a very small representation of what is ESCP. ESCP is extremely international institution where you have students from all over the world, including the ones that you see in the screen. So now that you know how to use Mentimeter, let's go through the only one slide that it has some theory. it's demand and supply. So in the horizontal axis here, we have the quantity of pounds. The vertical axis, we have the price, how much is each pound worth in terms of dollars. So if we are basically saying that for each pound we pay less and less dollars, there is going to be, if we say that the price of each pound is decreasing in terms of dollars, then that means that we are paying less for each pound, in which case that the supply is going to decrease, because those that basically sell pounds, they get less for their dollars. But on the other hand, we are going to see demand increasing, because then buying dollars is going to be cheaper for those that hold pounds. The other way around, those that want to buy pounds find it cheaper buying pounds given the price of the dollar. So this is economics. This usually takes 1 hour explanation, because we have to go through demand, supply, equilibrium, excess demand, excess supply. What I want to do this today is to just work with intuition, as we do usually in the business school, and just go through examples. And here again, remember the notion of scarcity. If one of the currencies becomes scarcer, then it's going to appreciate with respect to the other. So we want to understand why a currency might become scarcer. So here's the first question. And I'm going to let me read and then explain, and then you guys answer. So we are asking, does a lower rate of inflation in the United Kingdom than abroad cause an appreciation of the pound? So first of all, we have to understand the notion of inflation. Inflation means that the price of things go up. So basically, the value of your money goes down, right? You need more of this money to buy the same good if there is inflation. So we say if there is a lower inflation rate, means that the value of your money keeps kind of this value, is not evaporating because of inflation. So that means that if this is happening in the United Kingdom, if there is low inflation, pounds are becoming very attractive. So if they are becoming attractive, everyone wants pounds. And if everyone wants pounds, there is going to be appreciation of the pound because there is more demand for pounds. So now, given this brief explanation, many of you are just voting yes, yes, and that's the correct answer. Because there is low inflation, the value of money is worth, it's not evaporating its value, then there is more demand for that currency. And there is scarcity of the currency because of the higher demand, and therefore it appreciates. So very good, you got it. Congratulations. So that's the type of economic intuition I want you to work with in today's class. The next question I have for you is, does a fall in United Kingdom incomes relative to those abroad cause an appreciation of the pound? So now we are saying that like UK citizens are become poorer for whatever reason. Does it so that is the pound more attractive because of that? The explanation behind this is, well, if things are cheaper in the United Kingdom, like labor is cheaper, companies are going to relocate United Kingdom and set up business there. And if for that they need to buy pounds to do business, so the demand for pounds is going to increase. So given this, you expect that because pounds become more attractive, the scarcity is going to increase. So the answer would be yes. So as you can see now, some of you are voting no. And here I hope that this trade-off between the durability or scarcity of a currency and demand is appealing to you. So in other words, now if we see labor costs in the United Kingdom going down, then the country becomes more attractive. So you want to invest in that country. To invest in that country, to set up maybe a company, you need to sell your, say, euros to buy pounds. Then more demand for pounds means the pound appreciates with respect to the euro. So the answer would be yes. Now, what about the following question? Does a better investment prospects in the United Kingdom than abroad cause an appreciation of the pound? So now, situation is that things look great. You open your newspaper and you read that United Kingdom is growing, like things are gonna be very good in terms of business. What do you expect? So you expect that there's gonna be more demand for pounds because there is more trade in pounds because things go well. And therefore, more demand for pounds implies an appreciation of the pound because there is more demand. So all of you got this great. Thank you very much. Let me go to next one. Now, if speculators believe that the pound will appreciate with respect to the dollar, will the pound end up appreciating? So it's kind of like a self-fulfilling prophecy. Everybody says the pound is going to appreciate. What do you think the market is going to do? Probably is going to appreciate as well. So we expect then the pound to appreciate. That's because of rational expectations combined with optimism and good news. So the answer is yes, most of you got this right. Now, what about the following question? If British goods become more competitive in terms of quality than imported goods, does the pound appreciate? So what we are saying here is that now everyone wants to buy British goods because they are better for whatever reason. Now, more demand for British goods means that there is more demand for pounds because you buy British goods with pounds. So you have to sell your euros and you're going to buy pounds. With those pounds, you are going to buy British goods. So more demand for British goods means more demand for pounds. That means that the pound appreciates. And most of you got this right. That's great. Thank you. Next one, I'm going to show you a video, which is some of the exercises that also we do in a business school. We analyze a very short piece of a video that has some interesting discussion, and then we reflect on that video. So for that, I ask you to please wait. I'm going to share my screen. Do you guys see my screen? Tanya, do you see the interview in Bloomberg?
Yes, I can see the screen. Perfect.
So I'm going to play the video just for a second, and then we go.
You have a new book out, A Template for Understanding Big Debt Crises. And Ray, to me, the underlying message of this book is that history is doomed to repeat itself. Have I got that right?
Yeah, everything happens over and over again for similar cause-effect relationships, right?
So that sounds like an awfully depressing reality. Does it need to be a depressing reality?
Well, I mean, it's like any reality. You got to embrace the reality and know how to deal with it. There are debt cycles, and debt cycles provide great opportunities, and they provide real problems. So I think it's just like a progression, a disease that progresses. And the reason I wrote the book was just a compendium of research that I wrote mostly before the financial crisis. And it's because I think it's essential for everybody to understand the sequence of events, the logical sequence of events that makes these all the same. So as you know, there's 48 of them in there. They all play out pretty much the same way, except there are inflationary and deflationary ones depending on the currency. But basically, I'm in 60 pages. I just want to convey that template.
So let's talk about one of those two types of debt crises. The inflationary depression.
Mm-hmm.
Is that what's playing out right now in Turkey, in Argentina, in emerging markets more broadly?
Yeah, certainly. And this has all played out many times. This isn't the first time that Argentina's gone through it and has a habit of going through it. And it's not the first time it's happened anywhere else. So you could follow it. I mean, basically, the big deal is whether the currency is the debt is denominated in your own currency or in your foreign currency. And when it's denominated in foreign currency, like these countries have a lot of dollar-denominated debt, then they have a problem trying to service that dollar-denominated debt. When the dollar goes up and the money they're earning is in local currency, then they don't have enough cash, and then they get into that spiral. And as a result of that, they have to print more money, the currency depreciates, and it happens in a very mechanical way. Most of the countries don't have reserve currencies, don't have the debt denominated in their own currency. And as a result, most of their crises are of that sort. And there's a dynamic as to how they complete the cycle. In other words, what happens is when the currency goes down in value, essentially because of inflation and the like, they wipe out the local currency debt. If you own the local currency debt, you're wiped out.
You've evaluated 27 of these non-domestic currency crises.
Okay, guys, so when I get back to the slides, now you see this is the book actually they refer to. It's written by Ray Dalio, and he's an expert in international investments. The book is the title of the book is Big Debt Crisis, and what Ray Dalio is explaining there is that if there is an inflationary episode and your debt is denominated in foreign currency, for instance, you're in Turkey, there is inflation in Turkey, so the value of the lira, Turkish lira, depreciates because there is inflation. Then the problem would be if your debt is denominated in dollars, for instance, because then you have to put more liras to pay for the same debt, because basically you have $1, now you have to put more liras to basically pay for that dollar. So that's what Turkeys would do in that case. They would exchange their liras for dollars, and with those dollars, they pay the bank, they pay the debt. Now, as you can see, inflation is going to make liras less worthy with respect to the dollar, so they have to put more of their money to buy the same dollars. So it's going to be much more costly, and at some point, they are not able to pay for that. So he calls that an inflationary depression. Now, this discussion relates to what governments could do to alleviate such crises, but often, and this is what the author of the book is saying, in many times governments do actually policies that are not good for the country. So they keep printing money. For instance, a monetary policy that keeps printing money to help businesses, at the end, what it's doing is creating inflation. So if you have more money, money becomes more liras out there, liras become more abundant, so the value of liras go down with respect, say, to dollars. So that means the lira is going to depreciate, and you're going to also create inflation in your country because you're printing money. Let's see this 1 second. I'm gonna now show the screen again and actually the following. Well, not also, I'm gonna explain you the following. So first of all, what I just explained, higher inflation means that the country becomes less competitive. The value of money is less. You have to put more liras to buy the same thing. So they're gonna devaluate the currency. So that could be a problem. Now, if there is a currency devaluation, so the lira is going to depreciate with respect to the dollar. Now, those Turkish companies and individuals that buy goods abroad, they are paying more liras to buy those goods. So once you import those foreign goods into Turkey, the price in liras of those goods is going to be higher, which means inflation. So you are going to create what is called imported inflation. So more inflation means that the lira is going to devaluate, it's going to depreciate furthermore because of the same reasons I explained before. Now, this is the last slide I want to share with you before we go to Q&A. It's a slide that shows the Euro project. So we have the European Union, and some countries in the European Union adopted the Euro. Now, the struggle here is that, well, the good thing is that we all trade in the same currency. But the problem is that we lose monetary policy. There is only one central bank for all our countries. And sometimes like countries want different things. So maybe like Germany wants to increase interest rates because their economy is booming, and Spain wants to decrease interest rates to stimulate the economy. Then there is a conflict. So this type of debate that I just explained now it's something that we discuss in class. We spend a lot of time going through this. So just to sum up what in this brief lecture that we went through today, we explained the notion of exchange rate. We, instead of going through technical analysis that also sometimes we did in a business school, but I work today with your intuition. So basically I was emphasizing the concept of scarcity of one currency versus the other currency. Once you understand that, you will be able to do forecasting. Like you can forecast whether a currency is going to appreciate or depreciate. This is a very important skill that you want to have in the future once you go to the job market and try to find a job, because companies want smart people that are able to think by themselves and do forecasting. So that's just an example of what you could do with your company. You can advise them about a currency speculation or currency movements, and that they have to hedge that risk. And we have also gone through some questions. We have seen a video. We discussed briefly that in class, if it's during your bachelor, would be maybe 15 minutes discussion of the pros and cons, and then some reflections about major problems like the euro, which requires more of class material. But I hope you grasp it, the spirit of ESCP. It's very hands-on approach. We try to teach you topics that are gonna make a difference, so that you are different in your company. You are able to explain things in a professional way, and you are gonna work with topics that matter. For instance, the one that we show you today it's very important because all transactions of international companies are denominated in different currencies, and then therefore you have to understand that. So I hope you enjoy this brief lecture. I'm open for a Q&A session.
Yeah, it will be great if you could use actually the Q&A box that you have. There's a window there and a chat window. So for all questions, please put them on the Q&A, and that way Professor Jaime can answer them directly. Thank you very much.
I don't see the questions. It's going to be Tanya, so I just wait for Tanya to tell me what to do from now.
Exactly. Well, I'm just waiting to see if we have any questions at the moment. A ver, okay. We have a first question. In the last slide, why the UK is put as part of the euro? I don't know if maybe it was just like a typo because of the presentation. Sorry.
No, it was Ireland, not the UK.
Okay, and then we have another question. How can a political system affect the value of a currency?
Okay, that's thank you for the question. So the political systems are an important determinant of currency exchange rates. Old-fashioned, like say 3 or 4 decades ago, some countries adopted what is called a fixed exchange rate. So central banks were working to basically fix the value of a currency with respect to others. Now, the fashion is that we are working in a kind of intervened but flexible exchange rate system. So central banks allow currencies to move as the market demands, and at some points the central banks decide to intervene and inject money or withdraw money from the economy. So for instance, the political system that we adopted in 1999 in Europe was to abandon our own currencies, then adopt the euro and then have the European Central Bank injecting and withdrawing euros whenever they see fit. This is a good example of a political system. We decided to unite and to give our basically autonomy to a supranational institution such as the European Central Bank. Now, is this good or bad? There are different views depending whether you are one country or another. In general, like most of the countries in the European Union decided to stay, and it has cost, the cost being that you are not able to stimulate your economy by printing money, because that's the ECB. It's no longer, say, the Central Bank of Spain. It has good positive things as well. For instance, once you go and trade and do business in France or in Germany, it's always the same currency. So there is kind of price transparency. So I would say it has like profound implications, political systems, on how we design the monetary authorities and at the end, the value of the exchange rate. Okay, and there's actually I can see now the
okay. If you wanted, I was going to ask you the next one.
Yeah, so the next one is how the pandemic has affected the currency exchange rates. So there has been a flight, what is called flight to safety. It means that in a pandemic, everyone is scared, and money is also very scared and goes to something that is safe. So usually, like the safest currency in the world is the dollar. So there has been a flight to the dollar, and like in those emerging, more volatile markets, like money disappear. We actually have seen some currency speculation as well in Turkey, for instance, an emerging market. So that's a very interesting question. Another question is, what would be a good way of decreasing a country's debt without printing money? That's that's a good question. That's Ray Dalio's argument, that if we print money, then we are going to basically dilute the value of money. We are going to then increase inflation, because basically we have to pay more, say, liras to buy $1. And therefore we create inflation, we depreciate the currency, and that's bad for foreign debt. So a different way, or for instance, what Robert Dalio is saying in that interview, which is very related, it's that there needs to be enough blood in the industry so that the currency starts appreciating. So there has been a negative shock in the economy, and things has to basically rebalance so that the exchange rate is going to capture the real value of that currency with respect to another. Problem is if you have debt denominated in a foreign currency, then your companies will default. They are not, like, dollar debt becomes very expensive for them. So one way to try to intervene in those markets would be to try to sell dollars. So if you are a huge bank, such as the European Central Bank, you have reserves in different currencies. So you may want to intervene and say, I'm going to sell dollars to make things easier. But it's very unlikely that you are going to be successful in that situation, because you have the other central bank who has the monopoly in printing that currency that is going to maybe offset your movement. And a very good example of this kind of currency war is what is happening between China and the United States. There is a currency war in the sense that China wants to depreciate its own currency. And for that, the United States is responding, trying to also to depreciate their own currency, so that in trade terms, American goods become cheaper. But it's difficult once they are in a currency war with, say, a giant such as China. Another question, will Bitcoin eventually follow the exchange rate dynamics, or will it be more speculative? That's a beautiful question. We have actually at ESCP Madrid, one of our instructors of macroeconomics is an expert in Bitcoin and blockchain. And here, of course, the answer is yes. Like, Bitcoin is going to be like another currency. It's going to trade against other currencies. So it's going to be always the same as I was mentioning before. It's in relative terms, one currency versus the other. It could be Bitcoin with respect to dollar, euro with respect to the dollar, whatever combination. But only what matters to price Bitcoins with respect to, say, euros is going to be scarcity. And Bitcoins are designed to make that currency very scarce. But also you want to make sure that the currency is widely used. But for this, we could have like 9 hours of class talking about Bitcoins. It's a beautiful topic. Then another question, it's with buying property in France as an American expat or non-resident, will the currency, wait a second, it's moving, will the currency rate be more than a resident of France? So if I understood correctly, what you are saying is that if a non-French citizen goes to France and buys French property, will the exchange rate move? So it's a great question because, for instance, in France or in Spain, I would say almost like, I would say in Spain, I know that for sure, like 50% of foreign investments is American. So Americans are dominant in foreign investment. So if Americans then decide that France or Spain is the next target of investment in, say, real estate, they're going to inject their money. So for that, they're going to sell their dollars and they're going to buy euros. And with those euros, they're going to buy real estate in Europe. So because there is more demand for euros, the euro is going to appreciate. So that could be a short answer to your question. Then another question is, which effects do expansionary monetary policy and exchange rates have on a national policy? It has very important effects. Now we are living times where central banks in the United States, the Federal Reserve, and Europe is the European Central Bank, they print in like massive amounts of money. So effect number one could be inflation. Effect number two is there's going to be plenty of money out there and there is a search for yield. That means that investors now, because there's so much money, they are trying to get higher yield because interest rates are very low. And this is because there is plenty of money out there. So now if we are manipulating interest rates and inflation, you can imagine that it's going to affect the whole economy. There is someone that says thank you, and the last one it's someone is Gennaro is asking, with the introduction of digital fiat currencies in the future, such as the digital euro, what will be the result on exchange rates? So central banks, as the European Central Bank, they want their currency to be the only currency that is traded for exchange in the region. So if you go to Spain or France or Germany, you want to use euros. Now the threat that they are living is that now you have these cryptocurrencies that can be used as a mechanism of trade, and they have some things that could be positive for some investors, such as it's difficult to keep track of transactions and so on. So the European Central Bank and other central banks are basically trying to compete and make the euro being digital. So it's a huge debate behind. It's a beautiful topic. We address this topic a lot in our macroeconomics class in the second year of the bachelor, and we have excellent instructors going through that. I've seen that this is all your questions. Someone is saying thank you. I also want to say thank you to everybody here. I haven't met you personally, but I look forward to meeting you in person.
Yeah. Thank you, Professor, for this interesting masterclass and to let us have a sneak peek into your classes. It has been just amazing. And everyone, thank you for being here with us. Remember, we're constantly organizing events online. We have quite some webinars and quite some masterclasses. So if you want to look it up, just visit our escp.eu page There you can find all the events going on all our campuses, and we will really be happy to see you in further events. Well, there's one last question, Professor. I don't know if you want to answer it before we
Sure.
close up. Sorry for that.
Yeah. In the Q&A box.
Exactly.
Okay. Yeah, okay. Looking at New Zealand case, so their currency is going to announce, the central bank is going to announce the interest rates and monetary policies to adapt on a short term. How are these decisions taken? On which parameters? What are the differences in changing the currency rates on a long and short term? It's a very interesting question. It's not only like New Zealand. There are many countries that decided to intervene on a short-term basis. I mean, if you want to intervene in a long-term basis, basically you want to signal that you want certain stability in your currency. If your country is more volatile because it's an emerging market, or because suddenly like markets are volatile and there is an inflow of money that can destabilize your exchange rate, it can appreciate your exchange rate, and then it's going to hurt your companies because they're going to be less competitive because prices are higher. Some countries may decide to intervene on a certain basis, and Turkey has been one of those countries. And usually they play with a very interesting transaction or instrument, which is called repo markets. So repo markets are usually overnight, where basically you borrow against a very specific security, such as, for instance, government bonds, and therefore you are basically manipulating the overnight borrowing rate by intervening in this market, and therefore you might be able to decrease this volatility. But a short answer to your question is that once you face like very intraday or weekly volatility in your markets, and your currency might destabilize, that's when you want to intervene and start printing money, or buying or selling, borrowing and lending money to basically balance your exchange rate.
Amazing. Thank you for taking that last question. I think with this question, we can close this great masterclass. And well, we just want to wish you a great afternoon. Thank you, everyone. And thank you, Professor Jaime, for being here with us.
Thank you. Have a great day. Bye-bye.
Thank you. Hasta luego.